You know, a lot of people hear that word and immediately think of risk, complexity, and danger. And honestly, they are not entirely wrong. But they are missing the bigger picture here. Options are simply tools. Like any powerful tool, they can be dangerous if used incorrectly. But when you understand them, when you have a plan, they can help you achieve your financial goals much faster. Think of them as a way to add precision and leverage to your investing toolkit. You can use them to generate income, you can use them to protect your portfolio, you can use them to control great companies for a fraction of the cost of buying their shares outright. This guide is designed to introduce you to that power in a safe, structured way. Many investors start their journey by buying exchange-traded funds, or ETFs, SPY, VTI. This is a fantastic starting point. It gives you broad market exposure and allows your money to grow with the overall economy. However, this strategy is also passive. You are essentially a passenger on a large ship, moving at the speed of the market tide. While this is a reliable path, some investors eventually look for ways to take a more active role and potentially generate higher returns than the market average. This is where options strategies come into play. They are not about wild, speculative bets. Instead, they are about using defined plans to achieve specific outcomes, from being a passenger to being a captain of your own financial ship. The 4 strategies we will explore are designed for beginners who are ready to take that next step. They are methodical approaches that can significantly enhance your investment returns over time. Let's start with one of the simplest and most powerful strategies, LEAPs. The name stands for Long-Term Equity Anticipation Securities. That sounds complicated, but it is not. A LEAPS is just a regular call option with a very long time until it expires, typically more than 1 year away. When you buy a call option, you are buying the right but not the obligation to purchase 100 shares of a stock at a set price, the strike price, before a certain date, which is the expiration date. By buying a LEAPS call, you are giving yourself a long runway, plenty of time for the stock you believe in to appreciate in value. This strategy lets you control a large number of shares with much less capital. Imagine you are bullish on a company like Microsoft. Microsoft is trading at $450 per share. To buy 100 shares would cost $45,000, or buy a LEAPS call option instead. Look at the option chain. Pick a call expiring January 2027, about 17 months out. Choose a $450 strike. The premium might be $60 per share. That's $6,000 for one contract. For $6,000 you control the upside of 100 MSFT shares for a year and a half. Suppose MSFT rises to $550. 100 shares would be worth $55,000. That's a $10,000 profit. A 22% return on $45,000. Your LEAPS is now in the money by $100. The premium might be $110, making the contract worth $11,000. Sell for $11,000, minus $6,000 cost, $5,000 profit. That's about an 83% return on $6,000, nearly 4 times owning the stock. Best for long-term bullish investors using leverage wisely. Gain exposure to high-priced stocks without tying up all your capital. Pro, significant capital efficiency. Pro, amplified potential returns via leverage. Pro, long time horizon for your thesis. Con, options have time decay. Con, if the stock is below your strike at expiration, you could lose the entire $6,000. Con, you don't receive dividends when holding a call. For LEAPs, consider focusing on options with a delta of 0.7 or greater. This typically means the option will behave more like the underlying stock, giving you a higher probability of profit while still benefiting from leverage. The poor man's covered call, or PMCC, is a brilliant strategy. It's a diagonal call spread. The name comes from its similarity to the traditional covered call. The traditional covered call requires owning 100 shares. For Microsoft at $450, that's about a $45,000 investment. The PMCC provides a clever workaround. Instead of buying 100 expensive shares, you buy a deep-in-the-money LEAPS call to substitute for the stock. Example: you're bullish on Microsoft at $450. First, buy a long-term LEAPS call, say January 2027, 350 strike, deep in the money. Because it's deep in the money, it will behave very much like the stock. That LEAPS might cost about $120 per share, $12,000 total. Now for the income part, sell a short-term call against your LEAPS. For example, sell a 30-day call with a $470 strike. You might collect about $5 per share, $500. You've now established your PMCC, spent $12,000 on LEAPs. and collected $500 from the short call. Net cost becomes $11,500. Tip: for the short call and the poor man's covered call, consider selling calls with a delta of 0.2 to 0.3. This range often balances premium income and assignment risk, but always adjust based on the volatility of the stock and the overall market conditions. Your goal? Microsoft stays below $470 when the short call expires in 30 days. If it does, the short call expires worthless and you keep the $500 premium as pure profit. Then repeat next month. Sell another 30-day call and collect another premium. This creates steady income, lowers your cost basis over time, and produces positive cash flow. Ideal for investors with limited capital. It offers a great return on capital versus a traditional covered call. The pros are significant, highly capital efficient, generates regular income, and your leaps can still appreciate if the stock goes up. You can even run the poor man's covered call on a weekly basis, selling short-term calls each week to generate consistent weekly income. This approach allows you to create a steady stream of cash flow, making the strategy even more flexible and powerful. But there are cons to consider. The main risk is a sharp, unexpected drop in the stock. There is also assignment risk. If the stock shoots past your short strike, the buyer might exercise their option, creating a more complex position you'll need to manage. Synthetic stock is a strategy that perfectly mimics the profit and loss profile of owning 100 shares of an ETF, but does so with just a fraction of the capital. It may sound too good to be true, but it's a standard, well-understood option structure. The strategy involves two components: buying a long-term call option and selling a long-term put option, both with the same strike price and the same expiration date. When you combine them, the payoff graph looks identical to owning the ETF itself. This is ideal for investors confident in the long-term direction of SHLD ETF who want capital efficiency. Example: you want 100 shares of SHLD ETF, which is trading at $58. Buying the shares directly would cost $5,800. To create a synthetic position, use long-dated options expiring March 2026. Buy one call option at the $58 strike and sell one put option at the $58 strike. The premium you pay for the call and the premium you receive for the put are often very similar, sometimes a small net debit, or even a small net credit. Assume it costs you a net $1 per share, $100 total, to open the position. You have spent only $100 but created a position that behaves like owning $5,800 of SHLD ETF. If SHLD ETF rises to $68, your long call will be worth at least $10 per share, $1,000, while the short put will expire worthless. Your profit is roughly $1,000, just as if you owned the shares. If SHLD ETF falls to $48, your long call will be worthless, but you'll be obligated to buy 100 shares at $58 because of the put you sold. This results in a loss of roughly $1,000, just as if you owned the shares. Best for capital-efficient investors with strong bullish conviction, a pure leverage play. Primary advantage: incredible capital efficiency, frees up thousands for other investments. It perfectly mimics the unlimited upside potential of ETF ownership. Main disadvantage: it also perfectly mimics downside risk. If the ETF goes to zero, you are still on the hook to buy at the strike. Substantial loss. Many brokers require higher options approval and significant collateral or margin to allow selling the uncovered put. The wheel strategy is a favorite among income-focused investors. It's a systematic, repeatable process for generating premium and potentially acquiring stocks at a discount. It's more of a complete system than a single trade. The strategy revolves around two main phases. In the first phase, you repeatedly sell cash-secured puts on a stock you'd be happy to own. In the second phase, if you get assigned the stock, you then sell covered calls against it. This cycle allows you to continuously collect option premiums, effectively getting paid to wait to buy a stock, and then getting paid to wait to sell it. It's a beautiful, logical loop. Let's walk through the process. Step 1 is to identify a high-quality, stable stock that you wouldn't mind owning for the long term. Let's say you choose Coca-Cola, ticker KO, currently trading at $65. You decide you'd be happy to buy 100 shares if the price dropped to $62. So, you sell a cash-secured put with a $62 strike that expires in 30 days. To secure this put, you must have enough cash in your account to buy the shares. $62 x 100 equals $6,200. For selling this put, you might collect a premium of $1 per share, $100. Now, you wait. One of two things will happen at expiration. If KO stays above $62, the put expires worthless. You keep the $100 premium, and you can repeat the process next month. This is the ideal scenario, generating income without buying the stock. However, if KO drops below $62, you will be assigned the shares. You'll be obligated to buy 100 shares at $62. Your paper loss is offset. Your effective cost basis is $61 because of the $1 premium. You now own a company at a price you predetermined was a good value. Now you enter the second phase of the wheel. You own 100 shares of KO. You can now sell covered calls against your shares to generate more income. For example, sell a 30-day call with a $66 strike, collect 80 cents per share, $80. If KO stays below $66, the call expires worthless, you keep the $80, and you keep your shares. You can repeat this month after month. If KO rises above $66, your shares will be called away. You sell them for a profit. You bought effectively at $61 and sold at $66, a $500 capital gain plus all premiums. Your cash is freed up, restart the wheel. Investing in broad market ETFs like SPY is a cornerstone of sound, long-term financial planning. It provides diversification and captures the general upward drift of the market over decades. The average annual return of the S&P 500 has historically been around 10%, and that's a fantastic passive way to build wealth. However, the strategies we've discussed, LEAPS, poor man's covered call, synthetic stock, the wheel, offer a pathway to potentially outperform this benchmark. They achieve this by introducing two powerful elements that passive ETF investing just doesn't have: leverage, income generation through premiums. These elements, when used correctly, can dramatically change your return profile. Consider the leverage component. In our LEAPS example with Microsoft, a 22% move in the stock resulted in an 83% return on our capital. This amplification is a direct result of using an option to control the shares, rather than buying them outright. Synthetic stock takes this to an extreme, allowing you to control $10,000 worth of stock for a net cost of perhaps just $100. This frees up the other $9,900 of your capital. You could leave it in a high-yield savings account earning interest, or you could use it to enter several other similar positions, diversifying your leveraged bets across different stocks. This level of capital efficiency is simply not possible when you buy shares or ETFs directly. Then there's the income generation aspect. The wheel, poor man's covered call. By selling options, you are collecting premiums week after week or month after month. These premiums act like a dividend, but one that you can often generate on your own terms and at a much higher yield than traditional stock dividends. If you run the wheel strategy and collect just 1% in premium per month, that alone adds up to a 12% annual return on your capital. And that's before any potential capital gains from the stock itself. This consistent cash flow can be reinvested, creating a powerful compounding effect that can significantly boost your total returns over time. Of course, this potential for higher returns comes with its own set of responsibilities and risks. These are active strategies. They require more knowledge, more attention, and more decisions than simply buying and holding an ETF. You need to select individual stocks, choose strike prices and expiration dates, and manage your positions as market conditions change. The leverage that amplifies gains can also amplify losses if a trade goes against you. However, for the investor willing to put in the time to learn, these strategies offer a clear and logical path to potentially turning that 10% market average into something substantially more rewarding and engaging. We have explored 4 powerful strategies that can serve as your entry point into the world of options trading. LEAPS offer a capital-efficient way to bet on a stock's long-term growth. The poor man's covered call allows you to generate income on a budget. Synthetic stock provides the ultimate form of leverage for a bullish thesis. And the wheel offers a systematic, repeatable engine for collecting premiums and acquiring great companies at a discount. Each of these strategies, when understood and applied with discipline, can help you achieve returns that are difficult to match by simply holding passive index funds. They empower you to take an active role in shaping your financial future. As you begin this journey, it is crucial to remember that with great power comes great responsibility. The single biggest mistake a new options trader can make is to chase massive gains without first mastering the fundamentals of risk management. Before you place a single trade, you must understand concepts like time decay, theta, implied volatility. The Greeks: start small. Paper trade your strategies first to see how they behave in real market conditions without risking real money. When you do start trading with real capital, use only a small fraction of your portfolio, an amount you would be comfortable losing entirely. Your initial goal should not be to get rich, but to learn and survive. The journey from a beginner to a proficient options trader is a marathon, not a sprint. It requires continuous learning, patience, and discipline. Don't be discouraged by losing trades. They are an inevitable part of the process and offer the most valuable lessons. The key is to have a plan for every trade you enter. Know your maximum potential loss, your target profit, and your exit strategy before you even click the buy button. Avoid emotional decisions. Stick to your system. The strategies we've discussed are not just random trades, they are structured plans designed to give you an edge over the long run. By embracing these principles, a solid educational foundation, managing risk meticulously, applying proven strategies with discipline, you can unlock the incredible potential of options. You can move beyond the passive returns of the broader market and begin to actively craft a portfolio that generates income, leverages your insights, and compounds your wealth at an accelerated rate. The path is challenging, but for those who walk it with prudence and dedication, the rewards can be truly transformative. Welcome to the next level of your investment journey.